Question paper of June 2025, and we are going to look at the question on the preparation of the statement of comprehensive income. So our question reads, the following information is being extracted from the books of Railroad CC for the financial year ended on 31 March 2024. Prepare the statement of comprehensive income for the year ended 31 March 2024. So all the information part we are given extracted from the pre-adjustment trial balance on 31 March 2024. So very important in terms of our financial year. It means our financial year is ending at 31 March 2024. And then obviously it is starting the previous year, and that is 1 April 2023. So this is our financial year. Remember, our financial year is supposed to be 1 year. So in this case, it's very important for you to put down in terms of your financial year, because there are some proposed calculations which might need to be done in the question, so you can easily refer back to your financial year. So going on, we are given the balance sheet section. So we just need to go through everything in terms of what you are given in the question. We've got a list of balances that we have that you just need to browse through before you start to answer the question. So further on, you're given adjustments from adjustment number 1 going down to adjustment number 10. So these adjustments, you need to read them again so that whenever there's an adjustment which needs to be done, you can quickly pick it up. So in that case, we go to the answer section, whereby this is going to be your answer section. Of course, we have got some pre-entered information that are there. We have got start sales. So in terms of sales, we go back to our question. You see that we are given the figure for sales on this part is 6,250,000. And of course, if you go to the extra information, you'll see that it reads a credit note of 15,000 rands was issued to S Smiley, and this was not recorded in the books. A markup percentage of 50% is used in the business. So basically, you'd see that after you've gone through, before you start to answer, you've gone through all the adjustments, you can quickly pick it up that there is an adjustment that is affecting our sales. So in this case, we've got adjustment number 1, which we have a credit note. And remember, credit note is issued, and the credit note reduces the figure for sales. It represents sales returns. So in that case, 15,000 was not recorded as indicated. So we are supposed to subtract 50,000 from the total sales figure that we have. And then given that a markup percentage of 50% is used in the business, we also need to calculate the costs, which cost price, which we are supposed to also subtract from the cost of sales section. So in this case, we can start by subtracting 50,000 from 6,250,000, which is our sales, to get the net sales figure. So we can do that in brackets, whereby I say 6,250,000. Then we subtract the 15,000. So in that case, if you do that, you're going to get the 6,235,000. So you can put it in this column, 6,235,000. So when we go to cost of sales, remember, these returns are also supposed to affect our cost of sales. We are supposed to subtract from our cost of sales. So going back to the information given, you would see that we are having 15,000, which is obviously representing our selling price. Remember, our formula says our cost price plus our markup will give us the selling price. So in this case, our cost price is given. It's always 100%. And then we add our 50% as given as our markup. And then you get your 150%. So in this case, our 15,000 is the selling price, which is on this part. So we are saying, basically, we are saying 150% is equals to 15,000. And then the figure that we are looking for is 100% the cost price. So we are saying 100 is the one that we want to calculate. So in that case now, remember, what we don't have is 100%. So it becomes the numerator. And what we have is 150% becomes the denominator. And then we multiply by the given figure, which is 50,000. So simple proportion that you're going to apply here. So we calculate like that, you see that you're going to get your answer is 10,000. So in this case, our 10,000 is our cost price, which is supposed also to reduce our cost of sales. So we come, answer section and in brackets, we check the figure of cost of sales as given in the question. You see that cost of sales are given is 3,500,000. So 3,500,000, we subtract 10,000. So in brackets, so in that case now, we can try to calculate and see what we get. You see that we are going to get it as 3,490,000. So we are done on that one. And of course, we have to rule it off so that we calculate our gross profit. So remember, in terms of our cost of sales, we are saying less, so we are subtracting. So we can put it in brackets to show that we are subtracting. So if you say 6,235,000 minus 3,490,000, you're going to get your answer is 2,745,000, which you can put in the last column, 2,745,000. So that's our gross profit. Then you go to the other operating income section, whereby we are going to list all the incomes. The first one that we have is rent income. So we check in terms of our rent income. So our rent income is here. It is given as 270,000. So we have to check adjustments. If you have got anything that is affecting our rent income. Remember, the 270,000 of rent income represents the actual rent income that was received. But remember, when we are preparing the statement of comprehensive income, we prepare according to the matching principle or the accruals principle, whereby we say what belongs to the period should be recorded to the period. What doesn't belong to the period should not be recorded in that period. So in this case, this was the actual receipt, what was actually received, but it doesn't mean it's the rent income that belongs to the period. So we check in additional information. If we've got any adjustment, we have to adjust so that we remain with what belongs to the period. If there is no adjustment, the assumption is that the figure that we are given in the list of balances is the actual figure that belongs to the period. So we take the figure as it is and put it in statement of comprehensive income. So in this case, you see that net income, we've got an adjustment that is on this part that we need to effect. So in that case, we are saying it reads rent income was received for the months for April and May 2024. We know that our year is ending. Remember, we said we should put down our year. Our year is ending 31 March 2024. 31 March 2024. That 1 March 2024, and then the rent for April and May was received, which means we have got 2 extra months of rent that was received. So it means rent was received 12 months plus the 2 extra months, that is April and May, to get your total of 14 months. So it means the rent that we are having here is the actual rent received, which is 270,000, is for 14 months. So to get a monthly rent, you are going to say 217,000. We divide by 14. So we do that. We see what we get. See that we are going to get your answer is 15,500. So it becomes 15,500 per month. So this rent, the rent per month is 15,500. Then we want to remove the rent for the extra months that we have received that do not belong to the current period. Remember, April and May do not belong to the current period, so we have to remove those 2 months. So to get the rent for the 2 months, remember we've calculated for 1 month here. So for 2 months now, we are saying 15,500 times 2. And we are going to get it as 31,000. So it means the rent for April and May is 31,000. We need to subtract it from total rent of 217,000. So we come here. We show the calculation in brackets, whereby we are saying 217,000, then we subtract 31,000. So we see that the answer that we are going to get is 186,000. So we have the other figures: discount received, bad debts recovered as pre-entered. Then we go to profit on disposal. So we see the non-current asset that was disposed. So if come here, we would see that we have the information of non-current asset that was disposed as item 9. A trade-in of a vehicle for a new vehicle was made on 30 November 2023. The cost price of the old vehicle was 100,000, and then accumulated depreciation was 30,000, and then trade-in value was 85,000. So obviously we need to come up with a simple disposal account, whereby so on our disposal account, remember the cost comes on the debit, so the cost is 100,000, so it comes on the debit, and accumulated depreciation 30,000 comes on the credit. And we have got trade-in value is the amount that was used to dispose, is 85, should come on credit. Then we compare which side is greater. So if we compare, we see that the credit side is going to be greater with a total of 30 plus 85, which is going to give you a total of 115. So the balancing figure comes on the debit. So we are having a balancing figure of 15,000 on the debit side, which is supposed to go to the profit and loss. So it's going to be accredited in the profit and loss, meaning it's an income, so it's a profit on disposal. So we have a profit on disposal of 15,000, which we can summarize the working by saying 30,000 plus 85,000 minus 100,000. So we come here, we summarize the working in brackets, whereby we got it as 15,000. So we come and summarize that profit on disposal by saying 10,000 plus 85,000. 10,000 plus 85,000 minus 100,000. And then we've got 15,000. Okay, so on the next one, we have got provision for bad debts. Of course, provision for bad debts can either be under operating income or can be under other expenses. So depending, if it's a decrease, remember a provision for bad debts, which is also called allowance for credit losses. So if we have a decrease, it's income. If it's an increase, it's an expense. So depending on the question, but in this question, we have a decrease. So if it's an increase, we're supposed to put it under expense. So it's something that you have to check before you leave the other operating income section. So in terms of our calculation, we have to calculate the level of provision for the current period, whereby we are given the provision for bad debts must be adjusted 5%. So it's 5% for the current period. And then we calculate using the net debtors figure, of which we get that figure in the list of balances. We are given the debtors control figure is, we can check what we have. We're given it as 420,000. So 420,000 is the debtors figure. But of course, we do have some returns which were supposed to reduce the debtors figure, which were not recorded. 15,000 was issued to S-Smile, and this was not recorded. So S-Smile obviously is our data, but was not recorded. So it's supposed to reduce the figure for debtors 420,000. So we're going to say 420,000, subtract the 15,000 of returns. Then the net figure that we are going to get, we multiply by the level of provision, which is now adjusted to 5%. Then we multiply by 5%. So you see that if you do that, the answer that you are supposed to get now, you compare it with the current level of provision for doubtful debts, which is provision for bad debts, which is given as 24,000. So we can just try to calculate that one. Whereby we are saying 420,000, we multiply by, so 420,000, first we subtract 15,000, and then we get a net figure of 405,000. So here you are supposed to get your 405,000. Then we multiply by 0.055% as a decimal, and then we are going to get your answer as 20,250. 20,250. So basically that's what we have on that part. So on that one now, this is the current level of provision for bad debts, but at the previous years, we get it in the list of balance which are given as 24,000. So there's a movement from 24,000 to 20,250, which is indicating a decrease, and it's a decrease, it's an income. So it's a decrease of 24,000 minus 20,250. So we calculate it as such. We try to see what do we get. We get it as 3,750. So 3,750 is the answer, representing our decrease of provision for bad debts. And whenever it's a decrease, we said we should put it under other income, other operating income. So we are going to put it under other operating income is 3,750. And of course, in terms of the calculation, we said 24,000, and we subtracted 20,250. So that's what we have on that part on other operating income section. And of course, we now have to add the total for other operating income that's supposed to come here. So if we add what we have in the box, we can just create a box. So we're adding from 186,000 to 2,750. Then the total that we get, we put it in line with other operating income, of which if you add there, you are supposed to get a total of 215,750. So this is what we have. Then obviously now, if you add the 215,750 plus 2,745,000, 2,745,000, you're supposed to get your answer as 2,960,750. And then, of course, we also have our operating expenses section, whereby we have got some pre-entered figures for operating expenses. We are going to start from stationery. Some figures are pre-entered, so you can start. We can check in terms of stationery. So for stationery, we check according to the list of balance given. We have got a stationery amount of 44,000. And then 44,000 indicates the stationery that was purchased, but it doesn't mean it's stationery that is supposed to be regarded as an expense. Remember, the stationery that is regarded as an expense is stationery used. And stationery used, you get it by saying what was bought, 44,000, minus what is remaining at the end of the period. So we check if we have got any stationery that is remaining at the end of the period, according to our answer section. So if you go to additional information, you see that we have got stationery of 4,000. The following balances were obtained after the physical inventory count at the end of the year. So 4,000 is what is remaining at the end of the year. So we're supposed to subtract your 4,000 from the stationery that was purchased, 44,000, to get the stationery that was used. So in brackets, for stationery, So in brackets for stationery, we are saying 44,000, and then we subtract your 4,000. And then what you get, you're supposed to get your 40,000. So your 40,000 becomes your expense part. From there, we go to water and electricity. So for water and electricity, we check according to our list of balances. We see that we're given water and electricity here, which is 96,000. And we check if you've got any adjustment that is affecting our water and electricity. Of course, we need to go through everything. So you check in terms of all what we have, if we have got any adjustment on water and electricity. But if you go down, you see that we have got nothing that is affecting our water and electricity. So it means the figure that we have here for water and electricity is the actual figure that is supposed to be for the period, which is 96,000. So we take 96,000, we put it as water and electricity. Then, we go to salaries. Of course, for salaries, we have our figure as well, salaries and wages here, which is indicated as 420,000. And then we check again anything affecting our salaries in terms of our adjustment. So we start from information one going down, but we can see that we have nothing that is affecting our salary. So in that case, we take the figure as it is, which is 420,000, and put it here as our salaries, 420,000. We go to member salaries. We check member salaries. We're given Lewis 204,000, and then we are given for Aaron 180,000. So we can just enter them. We have 420,000. Sorry, we have 204,000 and 180,000. Then we go to rent expense. And of course, rent expense we're given it as 270,000. And rent expense, we check again its information, anything affecting our rent expense. But if you come on this part, item 2, rent expense has only been paid for 10 months. So it means the rent that we are having here, 270,000 is for 10 months. It's for 10 months. So what are we supposed to do? We are supposed to find the monthly rent, take 270,000, we divide by 10. Get your answer is 27,000. And we have those 2 months that are not yet paid, are not yet paid. So we are saying 27,000 times 2. 27,000 times 2, and you are going to get your answer is 54,000. So 54,000 is supposed to be added to 270,000 to arrive to add the rent that is supposed to be for the period. So we come here, we show that in our brackets is our rent expense. Whereby we are saying rent expense 270,000. Then we add our 54,000. And then the answer that we are supposed to get is 324,000. Then of course, we have got the next item that we want to look at, which is now trading stock deficit. So on our trading stock, we're given this 260,000, which is going to indicate our book value. But then in terms of our book value, we have returns which took place, which were not taken into account, of 15,000. So we are supposed to add those returns to 260,000. Remember, these goods are coming back into our stock. So we are going to say 260,000, we add our 10,000. We calculated the cost price and we got 10,000. And then the answer that we are going to get is 270,000. And then we compare it with the physical stock count figure. The physical stock count figure that we are given it as 252,000 here. So it's now 252,000. So in that case, we see that this now is the physical stock count figure. So if we have a scenario whereby the book value is greater than physical stock count, it becomes a trading stock deficit. But if the book value is less than physical stock count, then that's when we have a trading stock surplus and it's an income. But in this case, it's a deficit. So we have a deficit of 270,000 minus 252,000, which we just need to show in brackets by saying 270,000 minus 252,000. And you're going to get your answer as 18,000. So that's what we have on that part. So the next expense that we are going to look at is depreciation. And item 8 reads depreciation of equipment is calculated at 10% on carrying value, which is a diminishing balance. Diminishing balance, and we know that the formula for calculating depreciation using diminishing balance is percentage times carrying value, where we calculate our carrying value is equal to cost minus the accumulated depreciation. So first we have to find the carrying value, and we're going to apply 10% as per equipment. So we refer back to the information that we have. So the information given, we see that for equipment, we are given it as 460,000. 460,000, and then we subtract the accumulated depreciation for equipment, which we are given as 124,660. Then the answer that you are supposed to get after subtracting, you multiply it by the percentage for depreciation, which we are given as 10%. So you multiply by 10%. So you are going to see that the figure that you are supposed to get is 33,534. So we have 33,534 as depreciation for equipment. And we also have a depreciation for motor vehicles, whereby we are given that for motor vehicles, we have the one that was traded in and the cost price of a new vehicle, 150,000. So we are going to calculate three depreciations for vehicles. The new vehicle, the one that went out of 100,000, and the old vehicles that were there for the whole year. So we can start with the new vehicle. So new vehicle, on the new vehicle, we are saying it is equal to, we have 150,000 as the cost. Remember, we're not given a method of calculating depreciation for vehicles, so we can just apply the 10% on the 10% that we have here, and we apply it on costs. So on costs, we are saying times 10%, and we get 15,000. But we see that this vehicle was there, came in on 30 November 2023, of which it stayed only December, January, February, and March, and the year ended, so it only stayed for 4 months. So we're going to multiply by 4 over 12. And we see what we get on that part. So if you calculate by 4 over 12, we're going to get it as 5,000. So we have 5,000 depreciation for the new vehicle. Then we also have depreciation for the one that was traded in, which had a cost of 100,000. And then multiply by 10%. And it stayed the other months before the trading in, which is 12 minus 4, which is 8 months. So we multiply by 8 over 12. And we are going to get your answer as 6,667. That is to the nearest whole number. And then we've got all the vehicles that were there Remember, at the beginning of the period, we had the cost of vehicles of 750,000. So we are saying that 750,000 for old vehicles, 750,000. We subtract the one that was sold for 100,000, which is the cost of 100,000, and the one that is coming in of 150,000. Add it, and then the answer that you are going to get, you multiply by 10%. So you do that, you see that you are going to get your answer as 80,000. So now to get the total depreciation for vehicles, we're going to say this 5,000 plus 6,767 plus 80,000. And then we add to the depreciation of equipment of 33,534. So in brackets, we come here in brackets, we are going to say your 33,534. You add your 80,000, and then you add your 5,000, and you add your 6,667. And then we are going to get your total as of 125,000, 201. So that's the one on depreciation. So from depreciation now, we add to get the total for expenses. So if we add all the expenses that we have, you're going to see that the total that you are supposed to get is 1,705,601. So of course, this is to be in brackets because we are going to subtract it from the figure for gross operating income. So we're going to say 2,960,750 minus 1,705,601. And then we get your operating profit here is operating profit becomes 1,255,149. And then we check in terms of interest income, what we have. So for interest income, we refer back to the question. We see that we've got a fixed deposit of 500,000. I will check additional information. So additional information, what it says about a fixed deposit. We come to item 3. So you see that item 3 is the fixed deposit earns an interest of 8% per annum. So it means we are going to say 8% times the figure for fixed deposit that we have is 500,000. So 500,000 times 8%. So we can just try to calculate. For interest income, we are saying 8% times 500,000. Then we get your 40,000. So we have got 40,000. So with that now, the profit before interest expense, if you add 40,000, is going to be 1,295,000. So this one is wrong. So we are going to say 1,295,149. So that's what we have in terms of profit before interest expense. And then for interest expense, again, we check what do we have in terms of interest expense. Of course, we're given interest on members' loans as 17%, and then we're given interest on mortgage loan as 15%. So it means we are going to have two calculations that are going to lead us to the total for interest on loan. So we start with the 15% on mortgage loan, of which the mortgage loan is 1,200,000. So we're going to say 15% times is 15% on mortgage loan, and then we multiply it by mortgage loan is here 1,200,000. And then we go to the next one, which is we have got the mortgage loan and we have members loans 17%. So on members loans, we are going to say 17%. Members loans, we have 120,000 and 80,000. 180,000, and also we have 80,000. So basically, we are going to multiply. If you add 120,000 plus 80,000, we are going to get 200,000. So it means on that case, we are supposed to multiply by 200,000. So we multiply it like that. So you see that on the second part, we are going to get it as 34,000. And then on the first part, whereby you're saying on mortgage, 15% times 1,200,000, we are going to get it as 180,000. So we can now add the two to get the total for interest expense. So we are saying 180,000 plus 34,000. And then we get an interest expense of 214,000. Remember, interest expense, we are supposed to subtract it. So we subtract now from profit before interest expense, 1,295,149 minus 214,000 to get profit before tax, which is going to be 1,081,000. 1,081,149. So basically, that's what we have on that part. So we check in terms of the amount of income tax. We go to the list of balances. We see that for income tax, we are given the amount as SARS income tax 270,000. So this is the actual tax that was paid. So we need to find out whether it was more or less, or it was the actual amount paid for income tax by going to the additional information. So if you go to the additional information, you see that on the last part, we've got income tax for the year being 290,335. So this is the actual tax for the year, which is supposed to come here as 290,335. And we are supposed to subtract it, but of course we have to provide for the outstanding. And remember, what was actually paid is 270,000. So we are going to say in brackets 270,000 plus the remainder that was outstanding by saying 290,335 minus 270,000, you get 20,335. So if you subtract to get the figure for net profit after tax, you're going to get it as 790,000. 790,000. $790,840. So this becomes the final figure for net profit after tax. So this is what we have, guys, according to this video. Thank you for listening. And hopefully the video was helpful. And let's not forget to subscribe and share. And let's share the link to our colleagues who are doing financial accounting N6. Let's meet again in the next video.